Ghana's economic growth rises to 3.8% in Q4 2023. Nigerian Banks 2024 borrowing from CBN equals the same amount it borrowed in the first 11 months of 2021. Since hyperinflation rendered its currency useless in 2008, reaching over 231 million% inflation, Zimbabwe has been on a quest for a functional local currency. These are the talking points on the show today. Welcome. This is Business Edge. I am Perpetua Fasami Peter. We begin with African headlines. The Central Bank of Nigeria, CBN, under Governor Olayemi Cardoso, has successfully cleared all valid foreign exchange backlogs, settling a $1.5 billion residual balance for bank customers after meticulous scrutiny by Deloitte consulting auditors to ensure legitimacy, reinforcing the Nigerian economy's credibility and confidence. This clearance aligns with efforts to stabilize the exchange rate, combat imported inflation, and enhance trust in the banking system and economy, contributing to a notable rise in external reserves to $34.11 billion, attributed to heightened remittances and foreign investors' increased local asset acquisitions. The African Export-Import Bank, Afrexim, has funds totaling over $450 million available for investment in various sectors, including financial services, creative industries, oil refineries, and healthcare. The Fund for Export Development in Africa, FIDA, a subsidiary of Afrexim, has raised $770 million across 4 funds, with $300 million already invested. FIDA focuses on equity, debt, credit, and greenfield investment, aiming to raise a total of $1.3 billion. FIDA, FEDA, plans to make 10 to 15 investments this year, with a particular interest in manufacturing and logistics. The clearance of the foreign exchange backlog is part of Afrexim's strategy to stabilize the exchange rate and boost confidence in the Nigerian economy. The bank has reported a significant increase in external reserves, reaching $34.11 billion. South Africa's parliament has decided to refer the collapsed deal to sell a majority stake in South African Airways SAA to a special investigative unit. The deal, which aimed to sell a controlling stake to the Takatso consortium, was meant to end the need for recurring bailouts of the flag carrier. However, after a new business and assets valuation, the government and the consortium agreed that there was no clear path forward for the transaction. The Parliament's Portfolio Committee on Public Enterprises stated that the issue would be referred to the Independent Special Investigating Unit, SIU, to ensure accountability and transparency. South African government is to maintain full ownership of SAA, exploring asset-based financing without additional funding in the near future. These are the stories we're tracking at this hour. We'll take a break, and when we come back, we'll bring you Market Watch. Stay with us. It's Business Edge. The NGX All-Share Index extended the negative trend on Wednesday, losing 296.50 points to close 104,256.81 from Tuesday's 104,533.31. Similarly, the NGX market capitalization recorded a loss of 167.65 billion naira in naira terms. Now let's take a look at the numbers, beginning with the All-Share Index. Well, looking at the all-share index now, we have the percentage change here, 0.28%, and then we have it 104,256.81. Now, let's look at market capitalization. For market capitalization, the percentage change remains the same, and then it is 58.9 trillion naira. Apart from that, let's look at the top gainers from yesterday's market activities. And for the top gainers, we begin with CWG Computer Warehouse Group, 6 naira 5 kobo. That's a 10% increase. We have NEM, 8 naira 80 kobo with 10% increase. We have Julius, 6 naira 50 kobo with 9.98% increase. And of course, we have International Energy Insurance, 1 naira 45 kobo after getting 9.85%. And the last 5 we have here is Thomas Wyatt, 2 naira 18 kobo after getting 9.55%. Now let's take a look at the top losers from yesterday's market activities. TIP lost 10% to close 2 naira 16 kobo. NSL Tech lost 10% to close 54 kobo. FBN Holdings lost 9.90% to close 39 naira 60 kobo. Vitafoam lost 9.88%, and we have Beja losing 9.80% to close 15 naira 65 kobo. And now let's take a look at the sectoral performance to see what that gave us yesterday. For banking is in the red today, minus 1.79%. I remember yesterday they were all on the green, but today we have 2 down and we have 3 up. So beginning with banking, minus 1.79%, and then for insurance, plus 2.09%. For oil and gas, 0.24%. It's up today. And then we also have consumer goods, 0.14% up. And for industrial goods, it's unchanged, losing just about 0.00%. Well, that's the market rundown, what happened yesterday. And of course, market activity started already today, and we'll definitely tell you what happens tomorrow. So we'll take a break now. When we come back, we'll have our first conversation. Stay with us. Ghana's economy surged in the fourth quarter of 2023, growing at 3.8% after 4 consecutive quarters of contraction, led by expansions in agriculture and services. Despite this, it faced challenges throughout the year, including reduced government spending and high inflation, resulting in its worst full-year performance since the pandemic, growing at 2.9%. External factors like heavy rains affecting cocoa output and debt restructuring delays pose risks to future growth. Ghana seeks to address these challenges through debt restructuring and negotiations while forecasting modest growth. Joining me to unpack this is Patrick Abankwa, a financial analyst and investment advisor from Ghana. Thank you so much, Patrick, for joining me today.
Thank you, and good morning. Good morning. Good morning.
All right. Beg your pardon. I'd like you to give us an overview of the economic climate in Ghana and how the markets are reacting to the Q4 GDP figures.
I think generally for the 2023 performance of the country, we started off the year poorly because of the issues relating to the debt exchange program, which discussion started somewhere in November, December of 2022. So when we started the year 2023, the outlook was quite damning and not favorable, and that led to confidence in the economy not being strengthened and really getting worse. And that led to Ghana experiencing one of its highest rate of inflation over the last 15 years, which rose up to about 50% inflation. And that translated into the cost of living in the country and affected other industries. So going into the first quarter, second quarter, third quarter, we saw some improvement as discussions on the debt exchange program was progressing well. And I'm not surprised to see that the figures for the last quarter, which is quite an impressive performance compared to the other quarters of the year, shows that we are putting together a performance that, if we're able to sustain going into the year 2024, as we have already started, we should see significant improvement over what we experienced within the same period for 2023. So I think that kind of news gives some kind of confidence to the investors who have businesses running in the country, and also people who want to come and deposit some kind of revenues in this country by way of establishing some kind of investment opportunities over here. So I think that the outlook performance is quite okay. And even though we started poorly, we are at a place that if you're able to sustain our gains, we should get better.
All right, beyond some of the factors you have mentioned or attributed this growth to, can you share with us some of the factors you think are responsible for the growth we're seeing?
So I think that the first thing has to do with increased commodity prices. So some commodity prices increased within the period, which led to increase in profit for some of the institutions that are being affected. Again, there's also improved agricultural outputs. We saw some output for some of the agricultural products within the period, as you rightly mentioned, like cocoa, also improving within the period. Then the main sector that is driving the economy, which for me has to be protected, has to do with the service sector, which also experienced some kind of growth within the period. There can also be mention of the manufacturing sector, which also grew a bit within the period that we are discussing. So for me, these are the critical things. The first one is the commodity price. Second one is agricultural input that increased within the period. Then also the continuous growth in the service sector are things that for me led to the growth that we have seen in the quarter 4 of 2023.
All right, let's talk about Ghana's debt, which you also raised earlier. I mean, this debt has been one of its biggest challenges, if not the biggest challenge. How is this affecting investor sentiment and even confidence in the economy? We also know that Ghana is also trying to talk to some other bondholders to see what they can do about, their restructuring that particular loan. Looking at all of these, all the debt agreements, all the restructuring and all of that, what's the sentiment? What's the vibe? How are, investors reacting to all of these?
I mean, government's inability to meet the demands of investors by way of paying their coupons and also principal that have matured, for me, it raises a bit of worry for the government because their inability to meet its financial obligations and investment in future projects leads to some kind of hesitance when it comes to new investment coming in, and also can lead to potential hinder of the economic progress that we're experiencing. With that said, I think that the restructuring program has gone so far so well, especially with the closure of the local restructuring process, which ended somewhere last year, and also discussions with private bondholders to be able to agree on some terms. I think it's progressing well. What most of these investors are looking at is government's commitment to ensure that they are putting in place the right tax system, the right fiscal discipline, the right process to be able to manage its growing expenses. If the expenses are getting to the point where they are not sustainable, and that's the reason why we went to IMF, then it still gives investors some kind of fear. But I think that the government within the period has been able to manage itself within the fiscal discipline indicators that were agreed with IMF, and that is restoring some kind of confidence that we have seen, especially if you look at the performance of the year in 2024. Investors will continue to be investors, looking at their investment and how it's protected. So that should be the focus of the government going forward in terms of promising some kind of cogent steps that they can put in place, especially when it comes to spending, especially, again, when we are in an election year in Ghana, where every election year, government goes beyond its discipline when it comes to spending. So if you're able to stay within the indicators that have been agreed with IMF, I think that these investors will begin to see government in a different light and decide to perhaps bring up back their investment or even increase their investment or even give some kind of leverage in terms of extension of their credits that they've given to the country Ghana.
All right, well, Ghana is quite optimistic, just as you are, about reaching a restructuring deal with its creditors and also hopes to emerge from what is now known as the worst economic crisis in a generation. Is this a given? I mean, is it automatic? Is it something that will just happen just because it has, solved that problem?
It may not solve the immediate problems that we need to put our minds to. Having your debt restructured is just a matter of postponing your obligations. So when the obligations are due in, let's say, 5 years, 3 years time, what are you going to do? And that's where revenue is very important. So government should be able to put in place systems to recover revenue through the Ghana Revenue Authority so that we'll have enough funds to be able to cater for the postponement of interest that we need to pay. So that's one. Two is continuous commitment towards fiscal discipline. We should spend only what we have. And that means that if there's a need for us to cut down some government expenditure, we need to do that because that's the sustained way of being able to meet these obligations that have been postponed. Again, we should also put in place a proper economic reforms to ensure that the recovery that we are expecting will be sustained. And that will lead to us bringing down issues relating to inflation, issues relating to interest rate. As we speak in Ghana, average interest rate is above about 32%, 33% for businesses. How can a business go for a loan of about 32% and be competing with an international company that is paying about 5% from their home country in the same market space? This is something that if we don't address, it's just a matter of postponing the problem to another day. If you're able to address these things, for me, the challenges that we are facing will be thing of the past in the next 2 to 3 years.
All right, so quickly, let's just talk about the major risks, China is faced with on its path to sustained growth.
Yeah, so the challenges for me is still the issue of high inflation is still quite.
Go ahead. Yes, please.
Yeah, so inflation is still quite high. At the moment, we are around 26%. I think government should put in place through Bank of Ghana to be able to bring it down to the 10, 15 region that we saw before COVID. Again, our economic growth is also quite slow. We should also work at reducing and increasing the growth of that. Then exchange rate volatility. I think that our currency is still fluctuating from the beginning of the year up to now, our currency has depreciated about 30%, which is not good enough. And I think that effort should be made to bring that also down within a sustainable period. So that's what I think government should do going forward.
All right, thank you so much, Patrick, for sharing your thoughts with us today on Business Edge. All right, it's a wrap on this particular segment. We'll take a break, and when we come back, we have more conversations for you. Stay with us. You're watching Business Edge. U.S. Federal Reserve officials have maintained their outlook for three-quarter point rate cuts this year, but have revised down their forecast for 2025 due to an increase in inflation. The benchmark federal funds rate was left unchanged at 5.25 to 5.5% for the fifth consecutive meeting. The Federal Open Market Committee signaled its intention to cut rates this year, but now projects only 3 reductions in 2025 compared to 4 forecasts in December. The committee stated that the risks to achieving employment and inflation goals are becoming more balanced. Market expectations suggest a slightly better than 50-50 chance of the first rate cut coming in June, with a total of approximately 3 cuts expected this year. Fed officials have emphasized that projections are subject to change based on incoming data. The UK's pensions regulator is considering implementing an industry performance test similar to the one used in Australia to identify underperforming funds. The pensions regulator is examining the advantages and disadvantages of the Australian model, which involves an annual test using benchmarks to assess investment performance and tackle excessive fees. This approach has been effective in Australia, with several pension products failing the test since its introduction in 2021. The test has become a crucial monitoring tool for both regulators and workers in Australia's $3.6 trillion retirement industry. The British regulator is studying various aspects, including the time period and benchmarks used in Australia, to learn from their experience. China's stricter rules for consumer finance companies are expected to lead to consolidation in the sector, which provides high-interest loans to individuals who are excluded from traditional banking services. The National Financial Regulatory Administration, NFRA, recently announced more stringent rules prompting consumer finance firms to seek investors with deeper pockets or consider mergers. The new regulations require lenders to have over 1 billion yuan in registered capital, triple the previous requirement, and to secure a major investor holding at least 50% of equity. Some companies currently fall short of the capital requirement, and many lack a major investor. These rules aim to mitigate financial risks in China's economy and could attract larger financial and internet firms to enter the sector. The implementation timeline for the new standards is yet to be announced. We'll take a break now. When we come back, we'll delve into our next conversation for today. Stay with us. You're watching Business Edge. Nigerian Banks Borrowing from the Central Bank of Nigeria surged to 24 trillion naira in just the first 3 months of 2024. This reliance on the CBN standing lending facility window comes at a high cost, with interest rates exceeding 23%. Furthermore, the CBN has penalized banks for failing to meet cash reserve requirements. Tajuddin Ibrahim, Director, Research and Strategy, Chapel Hill Denham Securities, joins me for more on this. Good morning, Tajuddin. Good to have you join us today.
Good morning. Thank you for having me on the show.
All right. Nigerian banks have borrowed 24 trillion naira from the central bank in just 3 months of 2024. And this was about the same amount it borrowed within the first 11 months of 2021. Is this illiquidity staring us in the face or something else?
So definitely it is a reflection of liquidity challenges in the banking sector, because if you look at that number, it reflects the fact that the banks have been going to the CBN's standing lending facility window. And you see banks going to that window when there are liquidity issues with the banks. You will see them go to the window to borrow from the CBN just so that they are able to meet their own financial obligations as well. So it is a reflection of tight liquidity condition in the financial system, particularly in the banking sector.
Well, now that you've said that, some have said the monetary policies of the CBN, whether it's the MPC, the CRR, or even its drive to keep the Nigerian naira stable, have contributed to these. What are your thoughts? Is that what the case is?
So that exactly is the case. If you look at the CRR as we speak, the cash requirement, cash reserve ratio of the banks is 45%. And that is coming from previously 32.5%. And also, if you look at the interest rate environment, we have a situation where the monetary policy rate is 22.75%, and that number is up from around 18.75% level. So what that indicates is that the CBN is looking to mop up excess liquidity in the financial system by raising the CRR to 45%. Bear in mind the 45% cash reserve ratio in the banking sector in Nigeria is the highest among the 20 economies that we track globally at Chapel Hill Denham. So one would expect that the impact is enormous. The impact is significant on the liquidity conditions in the banking sector. So those that allude to that are spot on in that regard.
All right, talking about the CRR, there are those who would say that, okay, let's look at the guideline the CBN released on CRR, that what it said was that its deduction will not be the same method, that was used before now. What's the difference, really?
So the difference is that it allows some flexibility. And by flexibility, I mean, the previous method was a lot, more stringent than the current method. So the current method allows for liquidity to be examined on a weekly basis, and you will be debited, on your excess CRR, on your excess liquidity only based on the increase in your deposits on a weekly basis. So that is, a less stringent method, and it should allow the banks to have at least, some money to be able to lend out to the public. But the reality is that, they still, get to take away the excess, from them in terms of, CRR.
All right, so what does this portend for, the financial sector, really, and even the economy? A situation where banks do not have money. I mean, I'm just wondering, I'm thinking, how will they, fulfill their financial intermediation role or even some other things in that regard?
So obviously it is a challenging period, and we just have to be honest in this regard. It's a challenging period for the country. It's a challenging period for the banking sector. We should, focus on the larger picture. And the larger picture in this regard is the fact that we need to maintain a tight monetary policy, stance, because we need to let inflation moderate. Inflation at well over 31% is way too high. And the 31.7% inflation we are talking about is the second highest since 1996. The highest that we have seen in this economy was in 1996 in January, when inflation was well over 40%. So there is need to maintain a tight monetary policy to rein in inflation.
Let me come in here. Let me come in here. Okay, so I think you should just continue. I bet you're about to say, maybe answer the question I'm about to ask.
Yes, in doing this, basically what we need is to have high interest rates. And in having high interest rates, it is not sufficient this time. What possibly will make it to be sufficient is for us to have also higher CRR. And that is negative. Both of them are negative for lending. They're negative for consumers that will borrow. They're negative for bank customers. But that is what we need to do now to ensure that inflation moderates. It is sadly a sacrifice we have to make.
Let me come in here now. You have said that it's not a good thing where the banks are not liquid. And at the same time, you're also saying that to address inflation, we need the monetary policy tools. What about the fiscal policy tools? I remember there was a time that while the central bank or the MPC goes hawkish, on the other hand, there is the fiscal side, there is the development financing, there are other things on the side just to complement and also to strike a balance within the system. So if bank is essentially being starved of cash, I mean, it doesn't even just stop at the CRR or the MPC or the MPR, beg your pardon. We also have, the borrowings really. It doesn't seem the CBN is even slowing down its drive to mop up liquidity. It has borrowed so much from the domestic debt market within a short period. And this definitely mops up liquidity. So to what end is it doing all these? And what are these monies for to even start with? I think I asked about 2 questions there.
So let's take a look at it from this standpoint,
Okay.
right? If you are looking at the money that the CBN is borrowing, in this case, we are talking about the CBN and not about the federal government of Nigeria. So for the CBN, what you will see them do is to issue OMO bills, and the OMO bills issuance are for the management of liquidity in the financial system. When you allow your financial system to be way too liquid, what will happen is that you are leaving room for inflation to go higher, because there will be demand pulled inflation in that regard if you do not control the excess liquidity in the financial system. That is the reason that they sell OMO. If you now ask me, what do they use the money for? It is the same money that they rake in via OMO bill issuances that they eventually have to lend to some of the banks. Definitely not all the banks. Some of the banks that will be illiquid, it is the money that they lend to them. Let's take a look at 2 key numbers. Number 1, we take a look at 21%, which is around the discount rate for the 1-year OMO bill issued by the CBN. We'll take a look at the second number, which is 23.75%. That number is the standing lending facility rate. So in that case, you will see that there's a difference of about 2.75%. That is the spread that the CBN will benefit by lending to the banking sector for banks that need to access the SLF window of the CBN. But where did they get the money from? They get it from OMO bill issuances. So that is the reason they have to do OMO in addition to having to mop up excess liquidity. They also need funds that they can lend to banks that are not liquid at some point, so that they will meet their need in that regard. Bear in mind that we also have a situation where a part of that money is sterilized, just to ensure that they do not flow excessively into the public to be driving inflation. So those are the reasons that they do OMO bills to mop up excess liquidity.
Okay, so let me just before we go,
utilize the monies.
Just before we go, let's also add to it the federal government borrowing. I mean, looking at all of these things, I remember the last auction they did at that percentage. Number one, apart from the fact that, it sort of crowds out private investors, we also see a situation where even banks were complaining of liquidity challenges as a result of the auctions and all of the borrowings and all that. So how do we strike a balance at the end of the day?
So we need to strike a balance, and I think, the CBN, the federal government, are also monitoring the situation. If we take a look at bond auction for the month of March, for instance, we had, an inflow of about 475 billion. At the same time, we had a situation where over 700 billion naira matured in bonds in March. So what it means is that on bond issuance, the federal government had a net negative outflow of cash, because the 700 billion that matured is way bigger than the 475 billion that they raked in. So it is a case where the CBN and the federal government have to manage their cash flows. And I think what they have done so far is consistent with the plan in the budget for 2024. It is consistent with what I can regard as an efficient management of cash flow, if you ask me. But in terms of liquidity flows in the banking system, one thing we have to bear in mind is that even one of the members of the MPC committee commented that having excess cash in circulation, having excess currency in circulation is a major risk to inflation outlook. And I believe it is also consistent with what the CBN is doing to ensure that gradually they mop up excess liquidity from the financial system. So I think there is really not need for concern. I think they are on track in that regard.
All right, thank you so much, Tajuddin Ibrahim, Director, Research and Strategy, Chapel Hill, Denham. Thank you for your time, but I guess we're going to have this conversation some other time because there's a lot to talk about. Anyway, thank you.
It's my pleasure.
All right. We'll take a break now. When we come back, we have one more conversation for you, and you will definitely have a nice time watching. Zimbabwe is allowing a free fall in its currency that it's no longer keen to defend and is instead working on a new exchange rate potentially backed by gold. The country's local dollar has weakened against the US dollar every day in 2024, sending the price of a single loaf of bread from 6,105 Zimbabwean dollar to 19,357 Zimbabwean dollars in a mere 11 weeks. Such a loss of purchasing power has historically pushed the central bank to intervene and arrest the slide, but this time there has been no action. Joining us from Harare, Zimbabwe is Dr. Prosper Chitambara. He's an economist, a development economist, and he will help us unpack this. Thank you so much, Doctor, for joining us today.
Thank you so much for having me.
All right, so I'd like to begin from the very start, really. How did Zimbabwe get here with its currency?
Well, it's really been a long journey. It actually dates back to the late 90s when the local currency actually depreciated by a massive 100%, almost 100%, following the decision by the government to compensate the veterans of the liberation struggle. So that was not viewed positively by the market, and the local currency actually depreciated. So from 97, I would say up to the time of the inclusive government, which is around 2009, the currency was in a spin, and the economy was also in a spin. Then from 2009 up to until 2016, we had a period of relative stability. But from 2016 again, the situation begins to unravel up to what it is currently. So we haven't really been able to come out of the macroeconomic challenges, I would say, from 1997, probably with the exception of the period of the inclusive government. But the problems have largely emanated from issues of fiscal ill discipline and also monetary ill discipline. Our failure to control money supply growth, and also our failure to live within our means to control public spending. So I would say those have been the two biggest problems that we've had. And of course, they've also been exacerbated by other factors like the sanctions and even issues of corruption, institutional weaknesses. So there are a number of factors that have to be taken into account really to explain the state of the economy. But it's a combination of both internal factors and also external factors.
All right, so talk to us. What did you make of the Apex Bank's decision to just let the exchange rate, remain as it is? Although we all know it's working on a new exchange rate as announced by the president, is that enough reason to ignore the hemorrhage you were saying?
Well, I think it's two factors. So they're trying to liberalize the exchange rate system, fully liberalized, allow for the dynamic forces of demand and supply to play a greater role, rather, in terms of exchange rate determination. So I think that explains why we've seen the massive depreciation in the local currency. But of course, government is also working on a currency reform package, which has not yet been announced. But of course, there has been speculation that probably they're going to introduce an asset-backed currency, or that they will probably introduce a currency board. So it's not yet clear what government is going to do, but we know government is working, the central bank is working on a cocktail of reforms to try to bring stability in the foreign exchange markets.
I like how you put it, a cocktail of reform. So what would this cocktail be? Bearing in mind that Zimbabwe has tried several options with not yielding the desired result. And this is Zimbabwe's sixth attempt to have a functional local currency since 2008, when inflation, crossing 231 million% left it worthless. So what is this, what's this reform that we're anticipating? And are you confident that this current plan, to back the currency with gold will actually work?
Yeah. So look at having a gold-backed currency. I think it can be challenging in the sense that we don't have adequate gold reserves in stock to anchor the currency. It's actually estimated that we probably have around not more than 2 tons of gold in reserves. So it may be difficult to anchor a currency on gold when you don't have adequate supplies of gold. Then with respect to the currency board, it means the local currency will now be tied to an anchor currency, which could be the US dollar. But again, we need adequate reserves of the anchor currency to be able to defend the fixed exchange rate regime that a currency board actually entails. But of course, even over and above these arrangements, we also then have to ensure there's fiscal sustainability, fiscal discipline and sustainability. Therefore, implement other institutional reforms that are critical in restoring confidence in the local economy and also confidence in the local currency. So I think there's a lot that must happen to ensure that there is sustainability and stability, not just in the foreign exchange markets, but also in the macroeconomy.
You talked about a cocktail of reforms. I'd like to, go back to it. I mean, so far, we see that the monetary policy keeps trying all it can and all of that. You've talked about fiscal responsibility and all that. But really, what is the fiscal authority in Zimbabwe doing to ensure that the currency probably gains some strength or something?
I think from the fiscal side is where we've had challenges, I would say, in the past and even probably currently. Because public spending continues to rise, and the fact that we are also in a dual currency, it also then spells a trouble for the economy, because any injection of local currency liquidity then translates into a depreciation of the local currency. Why? Because most economic agents have lost confidence in the local currency. So the preference is to use or to transact in the USD. So it's difficult to really foresee when this maybe bloodbath is going to end, as long as we are in this dual currency, where you have a weaker currency circulating alongside a more stable currency. It means most economic agents would then prefer to use the more stable currency. But I think as we begin to build a track record of implementing these reforms, I think there will eventually be a restoration of confidence in the local currency and also confidence in the local economy. I think it's a process that takes time. When you look at case studies of countries that have dollarized, the de-dollarization process has not been very easy. It has taken a bit of time, and I think that's what we are also experiencing as an economy. That restoration of confidence in the local currency, it's not yet there. So I think it's going to take a bit of time, a bit of implementation of these hard reforms. Then eventually, I think we'll get there.
So how much longer do we have to wait for us to get there, if we can't just kick out the dollar?
Well, it's not as easy as kicking out the dollar, because that could even worsen the very sensitive or volatile situation. It's also not about going. So there are two extremes currently that we can adopt. We can go for full dollarization, which the authorities, I don't think they are willing to go that route. Then we can go the other extreme of doing away with the US dollar altogether. So my view is that those two extremes may yield disastrous consequences for the economy. So I think we are better off in this dual arrangement, where we both have the local currency and the USD, but try to defend the local currency. If it means using our gold, but we have to mobilize the gold reserves. If it means going the route of the currency board, I've seen some countries have actually done well with the currency board. So we could go that route, but again, it may be painful. So countries that have adopted a currency board have quickly abolish that currency board. Why? Because of the strong budget constraints that it actually entails. So that may not be very palatable for government.
The situation definitely is not enviable. Just before we go, in 30 seconds, can you help us paint a picture of the current situation in Zimbabwe, the current living standard of the people, the financial sector, how is it doing, and how are businesses coping in 30 seconds?
It's a difficult situation. We've seen an increase in taxes that has affected both the corporate sector and also households. And this year we are in a drought, El Nino-induced drought. So agricultural production is coming down. And we're also seeing the softening of global commodity prices, which is going to affect the economy. It's going to weaken our current account situation. So this year it's going to be difficult, especially for the ordinary citizen, the ordinary person.
All right, it's a pleasure having you on Business Edge today, Dr. Prosper Chitambara. I mean, the picture you painted is an interesting one, but I hope that things will get better soon. Thanks again for coming on the show.
Thanks for having me.